Are you tired of living paycheck to paycheck or relying on your 9-to-5 job to make ends meet? Are you looking for a way to achieve financial freedom? Look no further, because in this series we're going to show you how to invest in the right things and build your wealth. Welcome to part 1 of our series, where we're going to delve into the world of real estate investing. By the end of this video, you'll know the different types of real estate to invest in and how to start building a passive income that will lead to financial freedom. So, let's get started. Number 1. Rental property. Have you ever thought about investing in real estate to generate passive income? If you have, then rental property investing might be the perfect option for you. Rental property investing is a popular way to generate passive income and build long-term wealth. It involves buying a property and renting it out to tenants. The rental income generated from the property can provide a steady stream of income each month, and over time, the property may increase in value, allowing you to sell it for a profit. But before you jump into rental property investing, it's important to understand the benefits and potential risks of this type of investment. One of the main benefits of rental property investing is the passive income it can generate. Once you've purchased a rental property and have tenants in place, you can sit back and collect rent payments each month. Depending on the location and type of property, rental income can be a significant source of passive income. Another benefit of rental property investing is the potential for long-term appreciation. As the property increases in value over time, you may be able to sell it for a profit, allowing you to realize a return on your investment. Of course, like any investment, there are risks involved in rental property investing. One of the biggest risks is the potential for vacancies. If your property is not occupied, you won't be generating rental income, which can impact your bottom line. Another risk is the potential for unexpected repairs or maintenance costs. As the landlord, you are responsible for maintaining the property, and unexpected repairs can be costly. Additionally, if you have difficult tenants, it can be a headache to deal with. They may damage the property or not pay rent on time, which can impact your cash flow. Despite the risks, rental property investing can be an attractive option for those looking to generate passive income and build long-term wealth. So, how do you get started? The first step in rental property investing is to determine your budget and investment goals. Consider the location of the property and the potential rental income it can generate. You should also factor in any additional expenses, such as property taxes, insurance, and maintenance costs. Once you have a budget in mind, you can start searching for properties. Consider working with a real estate agent who specializes in rental properties to help you find the right property. Once you've found a property, you'll need to prepare it for tenants. This includes any necessary repairs or upgrades to the property. You'll also need to advertise the property and screen potential tenants to ensure they are responsible and reliable. If you're ready to take the plunge into rental property investing, do your research and make sure you have a solid understanding of the benefits and risks involved. Determine your budget and investment goals, and work with a real estate agent to find the right property. Number 2. Real estate investment trust rights. Are you looking for a way to invest in real estate without the hassle of being a landlord or purchasing a property outright? If so, then REITs might be a great option for you. REITs are a type of investment that allows investors to invest in real estate without actually owning or managing the property themselves. Instead, they invest in a company that owns and manages income-producing properties, such as shopping malls, apartment buildings, and office buildings. One of the main benefits of investing in REITs is the potential for high dividend yields. REITs are required by law to distribute at least 90% of their taxable income to their investors, which means investors can receive a steady stream of income from the dividends. Another benefit of investing in REITs is the potential for diversification. By investing in a REIT, investors can gain exposure to a diversified portfolio of real estate properties, which can help reduce the overall risk of their investment portfolio. Of course, like any investment, there are risks involved in investing in REITs. One of the biggest risks is the potential for market volatility. REITs are traded on public stock exchanges, which means their value can fluctuate based on market conditions. Additionally, the dividend yields from REITs are not guaranteed and can fluctuate based on the performance of the underlying real estate properties. And, as with any investment, there is always the risk of losing your principal investment. Despite the risks, investing in REITs can be an attractive option for those looking to invest in real estate without the hassle of owning and managing a property. So, how do you get started? The first step in investing in REITs is to do your research and determine which type of REIT is right for you. There are several different types of REITs, including equity REITs, mortgage REITs, and hybrid REITs. Equity REITs invest in income-producing properties and generate income through rental income, while mortgage REITs invest in real estate debt, such as mortgages and mortgage-backed securities. Hybrid REITs invest in both equity and debt. Once you've determined which type of REIT is right for you, you can start looking for a REIT to invest in. Consider factors such as the size of the REIT, its track record of dividend payouts, and the types of properties it invests in. If you're interested in investing in REITs, be sure to do your research and understand the potential benefits and risks involved. Determine which type of REIT is right for you and start looking for a REIT to invest in. Number 3. Real estate crowdfunding. Real estate crowdfunding is a relatively new way of investing in real estate that allows investors to pool their money together to invest in a property or real estate project. This can be done through an online platform that connects investors with real estate developers or sponsors. One of the main benefits of investing in real estate crowdfunding is the potential for higher returns than traditional real estate investments. Real estate crowdfunding projects can offer returns in the form of rental income, appreciation, and even profit from the sale of the property. Another benefit of real estate crowdfunding is the potential for diversification. By investing in multiple real estate crowdfunding projects, investors can gain exposure to a diversified portfolio of real estate investments, which can help reduce the overall risk of their investment portfolio. Of course, like any investment, there are risks involved in investing in real estate crowdfunding. One of the biggest risks is the potential for the project to fail, which could result in the loss of the investor's principal investment. Additionally, real estate crowdfunding projects are not as liquid as other investments, such as stocks and bonds, which means it can be more difficult to sell your investment if you need to access your money quickly. And, as with any investment, there is always the risk of losing your principal investment. Despite the risks, real estate crowdfunding can be an attractive option for those looking to invest in real estate without the hassle of owning and managing a property. So, how do you get started? The first step in investing in real estate crowdfunding is to do your research and choose a reputable platform. Look for a platform that has a track record of successful projects and positive reviews from other investors. Once you've chosen a platform, you can start browsing the available projects and choose one that meets your investment criteria. Consider factors such as the location of the property, the type of property, and the projected returns. Number 4. Real estate flipping properties. Flipping properties can be a lucrative way to make a profit. Flipping properties involves buying a property, renovating it, and then selling it for a profit. This can be a great way to make money in real estate, but it's important to know what you're doing before you jump in. Firstly, let's talk about some of the benefits of flipping properties. The obvious benefit is the potential for making a profit. If you're able to buy a property at a good price, renovate it quickly and efficiently, and then sell it for more than you paid, you can make a significant profit. Flipping properties also allows you to be your own boss, work on your own schedule, and take on new challenges every day. Now, let's move on to how to get started in real estate flipping. The first step is to do your research. You need to know the real estate market in the area where you want to flip properties. This will help you determine what types of properties are selling, what buyers are looking for, and what price range you should be targeting. Next, you'll need to secure financing. There are several ways to finance your real estate flipping projects, including traditional bank loans, private lenders, and even crowdfunding platforms. You'll want to explore all your options and choose the one that works best for your situation. Once you've secured financing, it's time to start looking for properties. This can involve searching online listings, attending real estate auctions, or working with a real estate agent. When you find a property that meets your criteria, you'll need to conduct a thorough inspection to determine what renovations are necessary and estimate the costs of those renovations. Finally, let's talk about some tips for success in real estate flipping. First, you'll want to build a team of experts to help you with the process. This can include contractors, real estate agents, attorneys, and accountants. Having a strong team in place will make the process smoother and more efficient. Next, it's important to stick to your budget. Renovations can quickly become expensive, so it's crucial to have a budget and stick to it. You'll also want to be realistic about your timeline. Renovations can take longer than expected, so be sure to plan accordingly. Lastly, it's important to have a solid exit strategy. This means having a plan in place for how you'll sell the property once the renovations are complete. You'll want to consider market conditions, timing, and pricing when developing your exit strategy. Number 5. Raw land investing. Raw land investing involves purchasing a piece of land without any development or improvement. This can be any kind of land: agricultural, commercial, residential, or industrial, with the aim of holding it for a period of time and then selling it for a profit. So, why invest in raw land? Firstly, raw land can appreciate in value over time, which can result in significant profits for investors. Unlike other investments, raw land doesn't depreciate or wear out, making it a low-risk investment. Additionally, raw land investing doesn't require a lot of money up front, making it accessible to investors with varying financial capacities. Finally, raw land investing provides investors with the opportunity to diversify their portfolios, which can help minimize their overall risk. Let's look at these examples. Let's take a look at some real-life scenarios. John bought a piece of raw land on the outskirts of the city for $100,000. Over the next 5 years, the area saw significant growth, and the land's value increased to $250,000. John was able to sell the land for a profit of $150,000. Similarly, Jane bought a piece of land in an up-and-coming neighborhood for $50,000. She held on to the land for 10 years and sold it for $150,000, making a profit of $100,000. Now that you understand the benefits of raw land investing, let's talk about how to get started. Firstly, research potential properties thoroughly. Look for properties in areas that are experiencing growth or development. Secondly, analyze the property's value and potential for appreciation. Consider factors such as location, zoning, and accessibility. Thirdly, negotiate the purchase price with the seller, and consider using a real estate attorney or agent to help with the process. Finally, make sure you have a solid exit strategy. Whether it's selling the land for a profit or developing it for future use, it's important to do thorough research and understand the potential benefits and risks before deciding which option is right for you. Thank you for watching. Don't forget to like, share, and subscribe to our channel for more informative videos.